One of the most popular questions I get is, particularly from new private practice owners, is really how to pay themselves. With the inconsistent cash flow, some great months, some not so great months, they can't quite figure out sort of how to pay themselves on a regular basis while they're still covering all the personal expenses they have between groceries and house and all that sort of stuff. And so today I want to break down sort of how I do that and provide sort of guidance in that process. And really it's about evaluating not only sort of the money coming in this month, but throughout the course of the year, as well as what's going out during that course of the year. Once we have a good sense of that, we can pinpoint sort of a good number for you to pay yourself on a month by month basis. So let's show you how. When speaking to clients about sort of how they manage the month to month cash flows, this is what I show them. Essentially, I take whatever sort of revenues they have and kind of break down sort of the yearly costs to the situation. And so they can have a very clear understanding of how much they can be taking out by a month or month situation. And so let's say we have someone with throughout the course of a year is going to make $130,000. We know based off previous tax situations that they expense about $30,000. Okay, so now from there we can actually evaluate sort of what an estimated sort of federal tax is going to be. We're not necessarily trying to nail that number down to the very specific dollar. Instead, we just want a general range because it's going to be hard to sort of estimate the actual sort of taxes. But you can use either your CPA's estimated taxes or go through this process where we're trying to take what you've told us and then incorporate sort of the credits, the deductions that we know you're going to get, and come up with a number that's pretty close to what you'll eventually owe. And so that's what we've done there. This person has no state tax and is not saving anything. And so from there, they know from life for the rest of the stuff, they have about $8,000 to spend. That comes down to $6,600 from the business every month. And really what we've done is take what is kind of an up and down experience throughout the course of the year, lengthen it out over the course of the time, and figured out sort of what you can get on a month-to-month basis. So if in certain months you make more than $6,600, well, that's fine. You're still paying yourself $6,600. In months that you're paying less, well, you should still be paying yourself about $6,600 because we know over the course of the year, all these things are going to even out and you're going to be pretty close to that revenue figure. So the other thing I wanted to show is sort of the impact of, opting into an S corp for certain situations. In this case, what we would have done is taken the revenues of 130,000, given the therapist a salary of let's say 60,000, and then business expenses of 30,000. From there, we can figure out the tax situation. They're receiving the rest of the money as what's called distributions after the business expenses, but those distributions aren't taxed for Social Security or Medicare, and so it's a lot less overall, even though they're theoretically making the same amount of money as they did without the S corp. And so when you get over a certain revenue figure, profit figure, you can really sort of start taking advantage of this. And so you can see what happens is that just gives them a little bit more to work with on a month-to-month basis, and their monthly take-home drops to $6,800 a month. Now, how do we incorporate savings into this? We incorporate it from the very beginning as well. And so we're taking the revenue figure, adding in savings. That's going to impact the tax. So instead of telling the IRS, hey, I started off with 130,000, it's essentially saying, I'm going to start off with 120,000. And from there, then we figure out the federal tax, saying we're using the S corp, so they're getting a certain salary, and then also paying less tax on the distribution that they receive. So that's what results in the smaller tax bill. And the life expenses are now $7,500 or $1,000, and from there you can figure out the monthly take home of $61.75. And so you can see how sort of breaking it down level by level, you can actually have a very clear understanding of what you can pay yourself, and then hopefully work within that on your personal expense side. Now, if that's not the case, then we have to figure out sort of what's going on the personal expense side as well. But hope that helps. And let me know how it goes as you try to incorporate this yourself. And then subscribe, and I'll talk to you again soon. Have a good one.